oil prices on Brent closing above $93 a barrel, 93.27 to be precise. I think the first time in 8 years or so, 7 to 8 year highs. So it's a significant progression forward. And in of itself, at the end of last week, we saw a big jump. So it was not so much progressive through the week, but certainly it made a leap forward. And then this morning we have announced Saudi Aramco, although not yet official, but reporting from the agencies that Aramco raising its OSP oil prices for the coming months. So all bullish. Mike Muller, head of Vitol Asia, good morning and welcome back to the table. Thankfully, it's only a few weeks since we had you last. The first Sunday of every month, of course, is your slot, and no better time to have you today. You told us last time, more or less, pointed in this direction firmly. Do you think this keeps moving from here?
Well, it's come $2.50 last week and about $2.50 the previous week as well. So it's not an unrestrained rally, but yes, markets have very high implied volatility at these levels, and we've moved from a market that at the end of the year seemed a little bit to be in the risk-off mode to people now seeming to take a greater interest in the energy complex. But the bit I like to come to straight away here is fundamentals, because there are a lot of people saying that, I've heard some of your podcasts last week, for example, suggesting that maybe there are fundamental signs of that are mixed. And my view is that it's a very resolute positive. There are reasons why the market is backward at the front, and so backward, so much so that the market is telling you, be careful, don't be short, because you're one disruption, one refinery wobble away from markets getting even stronger. So whether it's the backwardation in the distillate market, whether it's the fact that jet fuel is trading at or above gas oil, whether it's the backwardation in crude, these are all a manifestation of tightness at the front, where there is a scarcity or a perceived scarcity of supply, which has not been helped by a combination of many refinery closures in recent years for reasons we know, plus unscheduled refinery issues, plus certainly in Europe, the need to factor in higher gas prices and carbon prices into refining margins. So refining margins are telling you that refineries should be running flat out, because product cracks are at levels we haven't seen for many, many months. And as a consequence, that should be pulling very hard on crude markets. And inventories continue to sit at levels that are worrisome. And then we all start talking about where the spare capacity is. And the pace and rate of investment in the US is not quite what it was before. We're still nowhere near the peak that we saw pre-pandemic in terms of US production capacity. And the spare capacity in OPEC Plus is really down to 2.5 or 3 members now. And month after month, the 400,000 barrel a day that's being put on the market is actually, in effect, a much, much smaller number than that. Which leads us to a point in time, and we can debate whether it's second half of this year or sometime next year, OPEC spare capacity reaches levels that are considered alarming. And so much so that the debate has now swung to how soon we need Iranian supplies to help alleviate the situation, or whether there's indeed a need for more SPR, because the wave of SPR releases that Joe Biden's administration initiated over a month back were, with hindsight, just a small event. So, Sean, I've given you lots of ammo to dig into there, but perhaps over to Christoph for his thoughts.
Yes, Christoph Ruhl, Senior Research Scholar, Center on Global Energy Policy, Columbia University. Christoph, there's the aspect that Mike started out his statement with, his opening statement, saying that ultimately there's a lot of noise about all the reasons why prices are elevated, including geopolitical and other, but he is really focused on the fundamental tightness here, supply and demand principle. Your thoughts on that combination, we can review how much of this surge last week is being pushed by these non-fundamental factors.
Well, good morning. I find myself in agreement here, amazingly, with Mike for the first part. For all these short-term drivers, I would add one which could become very important. It's the cold winter, which seems to hit Texas in the US and could put some brakes on the recovery there in the Permian. But from the fundamental level, I'm a bit more on the restraint side. And there's really now 2 viewpoints emerging. You can see that in the spread of forecasts of investment banks and multinational agencies and things like the Energy Information Agency. It is, number one, a topic is coming back on the agenda now before spare capacity runs too low, which hasn't been on the agenda really since the 70s, and that's market share within OPEC. Because what we're seeing is, of course, aggregate spare capacity is sufficient to deal with these kind of price spikes, but it's concentrated, as Mike has said, in Saudi Arabia, a little bit in Kuwait, and then the UAE. And they show no sign of making up the shortfall from other OPEC members at the moment. The question is whether that will be sustained, how long it will be sustained, and whether they'll be risking a price spike and a crash and political pressure and all of that, or whether they try to extend the good times a little bit by giving in a little bit and steering the market further in a more gradual increase. Number two, also part of fundamentals, sometimes people forget about that, are expectations. And there are reasonably well-founded expectations that supplies from the US and from outside OPEC Plus in general are increasing fast enough to have a trend change in inventories, not only in 2023, but at the latest, I would think in the summer. I would still argue sometime in the spring. So production in the shale spot is increasing. They're back now at 11.9, I think, in the US in total. Or was it? I'm not sure about that number, but and we see supplies coming on. So in the meantime, on the demand side, we have the second post-COVID flash right now, but it's far from clear to me whether China and others will exercise continued strong demand. And the most important factor seems to be that we are really entering a interest cycle hike, which is higher than expected. And that could put pressures on economic growth just at the point in time when the supply side in oil markets is responding. That would be my fundamental picture. We will see this rally continue, and we may well see prices spiking across 100. I agree with that. But fundamentally, if that translates to the medium and long term, then by the midst of this year, so we should have two factors: more supply and these interest rates increases, which would put a dampener on that growth. Probably, if combined, just too much at the wrong time.
Mike, what are your thoughts on that sort of analysis that's coming from many, that this is a year of two halves? The first half will be tight. The second half it'll ease off. We had the US CEO of ConocoPhillips over the weekend saying, warning that people are underestimating how much US oil production could come back this year, as much as nearly 1 million barrels as part of that easing in the second half. Your thoughts?
I didn't read the ConocoPhillips CEO's comments as a warning. I read it as just a factual statement. And I think it was another 800 to 900,000 barrels a day of US shale production, which is the very least people would have expected. If you put me in a time capsule and sent me back a year and said, if the oil price were at $75 a barrel, how much extra production would you see in the US? I would have given you his number. We're at 90 something. So I think with WTI through 90, those numbers are reasonably modest, and they are a reflection of conservatism and the prioritization amongst oil majors, even the listed US majors, to not put all their eggs in the shale and indeed in the oil basket in this time of energy transition. So yes, I don't subscribe to the view that it's a year of two halves where the second half is weak, except everybody is building into their balances for the second half the return of Iranian crude. And it's really a question of when. And administratively, even if there were to be a reconciliation and an agreement to drop sanctions, the return of Iranian crude is not foreseeable in Q2, even under an express outcome. So one has to assume this is a second half event. And then it's a question of what sort of rate of ramp up is. And I think most observers will be aware that there is a floating inventory of unsold oil on ships that have been commonly referred to as, the floating flotilla of South Pass condensate largely. That would obviously get released into the market somewhat quicker. And then the rate of ramp up will also be reasonably quick. But the fact that it is in people's balances already and has been, without exception, every investment bank, every advisory consultant, every oil major, they all have a view that Iranian oil will be back later this year. And the forward market is still printing $1 a barrel per month contango, tells you that the world needs that oil.
Just on that note, just for the sake of reference, the quote by Lance, the CEO of ConocoPhillips, "If you're not worried about it, you should be." That was his quote regarding the recovery of US oil production this year. Christoph, the story over the weekend we saw as well, which at the end of last week into the weekend, was the Russian President Putin in China being greeted by the president of China for the Olympics. It's sort of this symbol of opposition to the Western alliance, to the US position vis-a-vis Ukraine, and this idea that China could be an alternative to Europe for Russian energy exports. Your thought of that as a posture that Putin can wave in the nose of Europe?
Well, there's two aspects here. One, I think it's incredibly significant, this joint statement which they issued, and this sort of, from what I read, full-hearted support which China gives to Putin's positions. And it's also significant in light, of course, of Taiwan, because look at the parallels. Ukraine is not a NATO member. Taiwan is not a NATO member. With Ukraine, the Western alliances have some vague obligation to defend the sovereignty of the country, but also said they wouldn't intervene militarily. With Taiwan, there's even a vague legal commitment to defend Taiwan, but no NATO commitment to put military on the ground. So it's very similar sort of scenarios. But back to your question, I think the history of sanctions generally shows that in the long and medium term, they're not very successful, at least not if regime change is the goal. And when you put stakes as high as accusing Russia of invading Ukraine, then regime change clearly is what people have in the back of their minds. What we have seen over and over is that in the medium term, in short term, they can cause pain, but often, that is not enough. And what we have here is like a pincer movement, a strategy of two sanctions. One is to cut Russia loose from the financial sector, from its access to capital, and along the way make it impossible for its elite to park money in the West. The other, to cut down on energy exports, gas and oil exports. And both are aimed, of course, at the balance of payment surplus, which the Russian Federation has, and which has helped it to weather all these storms before. In the long term, both will just increase global transaction costs. Energy is fungible and it's a global market. And if you have the alliance of sanctioning countries not closed, if you have a big consumer like China not being part of it, it will eventually be redirected and at a higher price finds its way to where it's used. And financial sectors, I mean, if you are the reserve currency holder of the world and you weaponize the payment system, alternatives will be found and will accelerate. So in the long term, this is just something which makes life more unpleasant for everyone. In the short term, the costs of Russia would be dramatic, but the costs of not the US, but Europe, as the sanctioning countries would, as we know, also be dramatic. And I think everybody would agree at this stage that maybe the US can carry the burden. Europeans have no appetite to carry the burden. So if there will be no maximum invasion, then there will be no maximum European sanctions. And now most people think along this trajectory, Russia as a rational player calculating the costs of sanctions and then doing whatever is just under the before massive starts. I think this is a bit too artificial. I do think that we need to get used, instead of speculating about the end point, to a frozen conflict, to a annoying military build-up and a constant risk which will be with us for probably a very long time, which will be sort of slow-boiling, continuous source of irritation.
Mike, welcome your thoughts on that as well, but also in the context of China's import appetite at these prices. There was some indication the price sensitivity there. They've got a lot of strategic reserves. They're more likely to draw on that than pay $90 to $100 a barrel in the open market. Your outlook for China oil imports?
Indeed, if I can just start with gas and that map you flashed up, it's quite interesting. If you just visualize that map, there was no connection between the East Siberian pipelines that can feed into China and the rest of Western Siberia and Russia that feeds into Europe. And until such time as the European side, let's say the West Siberian side, is connected to the infrastructure, there'll be no political leverage that a Power of Siberia 2 pipeline is to serve as a leverage to force Europe to pay higher prices. Otherwise, China will take the gas. However, there on that map, there was also a pipeline coming in from the Sakhalin 2 and 3 project in the north of Sakhalin Island. And there was talk about making a connection from that through Mongolia into China also, which would be an interesting one. And the Power of Siberia line is that one you see that ends up where it says towards China. So yes, it is great rhetoric, but it's a massive expanse of Siberia there, and there's an east and a west to it. So that point is worth highlighting. Now, as for oil, I mean, all the headlines have been made on gas of late, but there have been comments that China has been hoarding and building inventories of oil. I think it's fair to state that China is at bare minimum operating level in terms of the prescribed levels. mandatory stock holding that the state-owned enterprises are meant to hold. And we've spoken many times about the government measures to further restrict the operations of the independent sector, sometimes referred to as the Shandong teapots, also some of them further north in the province of Liaoning. But I think all eyes on what happens in China after Chinese New Year, because there is a feeling that some restocking will be required. And if you look at the spot behavior at the very front of the market, it doesn't look like they've had their foot off the pedal. Up until the very last day before Chinese New Year, the Chinese state-owned enterprises seemed interested in buying crude at these prices. So I don't think China is as price sensitive as South Asian nations are. And again, drawing parallels with gas, it was very telling that when LNG prices went to unprecedented levels a month or two back in December, South Asia just did what it did earlier in the year as well. It went on buying strike. It just stopped buying, and the consequences means that factories reduce operation in things like textile sector, cement sector, and the lights go out for rolling brownouts across cities, whether it's Pakistan, India, Bangladesh, etc. But no such thing from what we can tell in China. And let's also remember that China has the ability by policy to just force the coal sector to ramp up dramatically. But coal prices aren't sitting still either. They're at all-time record levels again, not in China, but certainly elsewhere. Not helped by the disruptive export policies of Indonesia, which tried to strong-arm exporters into putting supplies to the domestic utility first and paying penalties if they didn't do so. So all utility markets are currently pretty strong, and all eyes on the weather. And indeed, as Christoph said earlier, we've seen in previous years what cold weather in Texas and Oklahoma and places which are oil and gas producing can do to that sector. That, of course, is the underpriced market so far, but the world is relying very heavily on gas exports from the US Gulf to balance a perceived need by Europe. So it all hangs together a lot. But I mean, China had what they called Chinese New Year travel rush, which was up 48% versus last year. It's still down on 2020, which we must remind ourselves, there was a problem in Wuhan, but there wasn't yet a travel restriction for Chinese New Year 2 years ago. So it's still down on 2020, but it's very much up on last year. And colleagues of mine in China are not under any pressure not to go visit their relatives in other provinces. There's relative freedom to travel, albeit.
You remain somewhat bullish that imports this year will exceed last year. We won't see another year of declining imports.
There's a massive question on that, because we saw the Chinese refining system go to 15 plus million barrels per day, and people are forecasting it won't go there again. But we've got extra refineries on stream, right? Shenghong is a brand new refinery. Rongsheng's ramping up, and its phase 2 wasn't fully in place for the whole of calendar year 2021. So China has to and will run more because these are integrated petrochemical complexes which are designed to have a margin and designed to run at 100%. And they will have to build the inventory and the line fill that goes with all this. Plus, of course, there will be strategic inventory, line fill, unit fill for all these new units, which is going to consume extra oil. And I think the same goes for natural gas. I mean, Chinese LNG consumption.
I can't hear him anymore. Sean.
Okay, I can hear him. I can hear Mike, no problem.
Sorry, I'm not reaching the Black Forest. Oh no, sorry, I'm not reaching Dubai, Christoph. I'll make it quick. The LNG demand in China year to date has had people raise questions whether China will repeat the massive increase in LNG demand, which we saw 2021 on 2020. There is a view that ought to be the case, but there were some very confusing signals put out just 2 weeks back when some SOEs came out with major LNG cell tenders. Although they ended up seeing an uptake for those LNG cargoes that was much less than they tendered out, so just a fraction of the cargoes they said they were going to sell. But it is just demonstrating the muscle that Chinese SOEs can flex in all energy markets at the moment, be it coal, be it LNG, be it oil.
Christoph, the other big story Christoph, can you hear me?
Yes, I can hear you now.
Okay. The other big story last week, and it was obviously has been for a while, but pronounced last week, record gasoline prices, at least 8-year highs in the US, in Canada. We saw record inflation announced in Europe, central banks noising around tightening. Where is that in the market at the moment? It looks to a certain extent like the equity markets have kind of spit it out a bit. Where do you see it impacting and where does it go forward, do you think?
Before we do that, can I just...
Yes, please.
I wanted to systematize a little bit the bits and pieces Mike has laid on the table there.
Please.
Because as far as China is concerned, it's true that what is important is the ability to ramp up coal production, but that's important for the gas market, for LNG imports. So that's where this flexibility comes from. If you look at oil markets, what matters there is whether these inventories are product inverse inventories or in the form of crude oil. What most people, this is not published, but what most people think is that the new built inventory storage, which should be there over the last few years, is the form of crude oil storage. And what we then have is a situation where when you listen to those people, either economists or those people who run satellite observations and all this kind of stuff to try to figure out what's going on the ground floor, they would agree that crude oil inventories, strategic inventories have massively increased. And so I think you probably get two sets of pictures when you look at product markets. So the crude situation, to the extent that you can look at it, and you have to separate that from the gas and the coal question. On the inflation and outlook, I've said this before, and it's rising energy prices, of course, directly feed into inflation. So do the rising food prices, which we have at the moment. And central banks are aware of that, consider them a cyclical irritation very often. And therefore, the preferred inflation measure of the Fed is not the CPI, but what they call the core CPI, which is the consumer price index minus changes in energy and foodstuff. Both of them are still increasing. And of course, what matters for the public and for the political discussion is the CPI, including energy. And so yes, that will have an impact and will have a continued impact. And for the policy discussions, where we're going here is what economists are looking on, is whether the inflation rate is continuing to rise or whether it stabilizes or falls. And stabilizing would be good news in the sense that people think then expectation of future inflation will be more anchored and the demands for price increases or wage increases, the spiral will be further removed. If inflation rates go up, then of course you have immediately people losing trust in the system and saying, now my wage needs to go up as much because next year will be prices even higher. And firms with pricing power immediately using that to the full extent. And that's the dangerous situation we're in right now. And to that extent, higher gas prices always might be headlines, especially in the US. And that will just feed into the same kind of political discussion, putting higher pressure on Biden and his government and being of relevance for the midterm elections, which are in front of us.
Let's get the survey question in, which sort of addresses the earlier point we discussed on whether Putin can kind of wave China as a threat to Europe. Does China present a realistic alternative market to Europe for Russian energy exports over the medium term, 5 years? Yes or no? Can he go to Beijing and wave that? Mike, I welcome your thoughts on this point. It becomes the question of demand destruction. And is it something that we have to think about in 2022? You said other areas of Asia a little bit sensitive to the pricing of energy now. What's your outlook for energy demand destruction with hydrocarbons, in particular oil and gas, at these levels? Mike, you're on mute, sorry.
My apologies. It's an extremely confusing picture on this demand elasticity point. The point I was making was relating to LNG, which in oil terms went to $300 a barrel or something ludicrous. It's unthinkable for oil. So, I mean, let's just remind ourselves, the world was at $110, $115 a barrel for nearly 4 years solid, from 2011 to 2014. That's just 7.5 years ago before the price correction occurred then. And if we go back and model how much demand destruction occurred there, and what the impact was on the economy, the market's been there before. And yes, of course, there is some sort of view on this. I heard one of your Aussie commentators on Thursday comment about behavior in Australia where people refuse to drive if the gasoline price goes to a certain level. Yes, there's an element of that, but I don't think it's anything compared to what's going on with people's household electricity gas bills, which is eating away at people's disposable income also. So yes, lower middle income and low income strata of even the Western world, let alone the developing and the emerging markets world, will abstain from consuming quite as much energy as before, given what's going on. However, I don't think it's a linear thing that kicks in at $90, $95, $100 a barrel oil. I don't think that's so noticeable.
Well, I mean, if you look at what's just announced on Bloomberg this morning in terms of the OSPs for March, I mean, up 60 cents on Arab Light. It's chunky enough for Europe or for Asian refiners.
Yeah, I've got them up in front of me here. I mean, that's exactly spot on with expectations. So for once, the OSPs from Aramco didn't surprise, and that's the Asia number, of course. But you saw very chunky increases in the Western Hemisphere, which is basically Aramco saying we can find enough demand in Asia, which is a high price market anyway. So I think yes, it's up, but it's got to be up because month on month you've had a massive increase in backwardation, and the backwardation feeds through into differentials and into the OSPs in a very logical manner. So yes, it's up. It looks bullish, but they're not telling the world don't take our oil or anything like that, or we only want to sell to top tier customers. They've done what the market expected this time around.
Christoph, I mean, just coming back to the point of inflation, while it has been a narrative and it's sort of a broken record on some level, the reason I keep coming to it each week is because each week we seem to be adding an extra layer. You know, it's only a few months ago there was no rates for 22, then it was 4 a week ago, now it's 6, 5, 6. I mean, the number of mics putting 5 up, but I've seen 6 built in and so forth. My point is this every week seems to be the cycle, the number, the tightening. At what point, and the market keeps kind of spitting it out, I'm just wondering, where is it going? And does it create the expectation that the Fed in particular will need to go with a much bigger rate to start off with than sort of this quarter point piddle?
What we are seeing is the ugly picture of unraveling expectations, exactly the kind of thing central banks want to avoid at almost any cost, losing control over the narrative a little bit. They wish at this point, if I can say that, probably to have as steady expectations as OPEC Plus has created with its 400 every month, and everybody knows it. And then the people realize, okay, it's a reality, it's just 200, and then they draw their conclusion. The Fed is in a totally different position because remember that they really, until the forecast for 2021, last December 2020, they said there will be no inflation. It's not a danger. It's a transitory phenomenon. And then they got hit in the US with 7% inflation for 21, in Europe with more than 5% inflation for 21. And now you have a market which is already, as you know, is completely overvalued in many respects, so especially in particular sectors, and which was risk on market for a very long time. And so you see the frantic reactions which are normal for this kind of short-term investments now spilling over into the financial press, into the reporting, the inflation numbers spilling over into people's electricity and other food and other bills, and becoming a topic for broadsheet newspapers, so to speak. And this is exactly what I observe at the moment in Europe. I'm not reading the American press so much. It becomes a headline figure and people get worried, and that is the kind of take of fuel which central banks are supposed to not let into existence that we have now. So I think it will be just another sort of role which energy prices play, even if they economically don't add up, not that important anymore. That if oil prices and natural gas prices would in the spring or in the summer calm down a little bit, and that would feed back on the broad measure of inflation, that would be good and beneficial for economic policymakers. If that's not the case, and the broad measure of inflation continues to rise, then we may be really in a bit of trouble, and we may require rate hikes which are so that they hurt the economy. Having said all this, just a final point. When you have an inflation rate of 7.1%, 7.2% in the US, 5.1% in Europe, and you have an interest rate of 0.25 in the US minus 0.25 in Europe, even if you increase your rates by 2 or 3% over the year, you are still having a negative interest rate, and that means you still have expansionary monetary policy, and that means you still have more money sloshing around than can actually be deployed for expenditures, and that means you still have high demand for assets, such as equity or real estate or whatever else builds these asset price bubbles, and energy, of course.
Let's get the survey result. Give Mike the last word this morning. Yes, does China present a realistic alternative market for Europe for Russian energy exports over the medium term, 5 years? Yes, sort of 2 to 1 in this room at least. Not sure about that, but nonetheless, that's the view of the room. I voted no myself. But Mike, I wanted just to get your views, sort of closing out on inventories, clearly continuing to be depleted, such so that we're seeing Russian exports of diesel to the United States last month hit the highest in 3 years. The increase in Russian diesel deliveries come as fuel inventories on the East Coast have fallen to the lowest in 8 years. My question to you is, what other distortions are in the market at the moment because of the continued erosion of inventories?
Yes, as I said at the outset, diesel is a good one to focus on because of the cold weather and the lack of inventory. And just a few refinery incidents have tipped this market into a very steep backwardation and disincentivized anybody to store, made it very expensive for people to blend, and also disincentivized people from taking long voyages and doing long haul voyages. Because why pay the backwardation if you can go to a local market and sell at a small discount than going to the other side of the world? So yes, we've had a couple of refinery issues dogging Asia. For example, the latest one was the issue around the operation of the KPC joint venture refinery in Vietnam. And there were a couple of other issues around other parts of Southeast Asia. And we mustn't forget, of course, refining capacity is down. I mean, we've got Singapore refinery of Shell running at half its usual rate. The same company closed their refinery in the Philippines, and we've had a conversion in New Zealand of the only refinery there to a product import terminal. That sort of trend aggravates things when there's less slack in the supply chain. And if you throw on top of that a good dose of COVID-affected port agents and lines workers and pilots and crew changes being hampered by these things, everyone wants to plan to have adequate supply in the system. Throw in a dose of cold weather, and let's again look at the news, and you'll see that it's all the way down to the southern states, Texas, etc., in the US, and we've seen what that can do in the past. It is potent, and it is telling the market, be careful, don't be short at the front of the market, because just one incident away and we can get even bigger backwardation, and shorts could get very, very badly impacted as they seek to exit their positions. So the other issue is the market is still relatively risk off. The commitment to trader reports and the general index of managed money being in the market is still nowhere near where you'd expect to see, given some people consider oil to be a good inflation hedge. And is that money going to be tempted to come into a market which has a positive roll yield of more than $1 per barrel per month backwardation? One has to suggest perhaps yes, as the stock market looks a little more jittery and the fundamental picture on oil is a very resounding thumbs up. Demand is currently making the headlines and supply is the problem. So I think the fundamental message is pretty attractive to money markets who appear to be on the sidelines still. And whilst there is a risk in a market that has very limited open interest that the sell side starts talking the market up to 100, etc., it does look pretty robust. But implied volatility in options markets is at record levels we haven't seen for a very long time. And we've seen earlier in Q4 that the market is capable of $10 a barrel pullbacks, all of which then get put back on in a matter of weeks. So it's not for the faint-hearted.
And that's a wrap for today. And it's not even, did we mention that Saudi Aramco are looking at selling off another 50 billion tranche of their company on the markets? The labor jobs report out of the US last week we didn't get on to, which was quite robust, and they revised the figure for December, which itself was revised up to quite a big number, 500,000 I think the number was. And ultimately the outlook for all sorts of supply disruption through the year. We've got Ford Motor Cars referencing that they're going to have to close down activities at a number of plants because of the availability of chips, supply shortages all over the place. So this inflation piece, I think, is locked in for this year. And one would have to keep an eye on how dramatic and how big central banks are going to have to go to get a grip on this. And then what are the dominoes that will fall from that? That's one to keep an eye on for any signals in this coming week. As always, Mike Muller, thank you so much. Have a great February. We look forward to seeing you next month. And also, Christoph Ruhl, as always, anchoring the Sunday. Great to have your comments and insights from a windy Abu Dhabi. Have a great day. We're here every morning, 10:30 UAE time. All the best.
Thank you, Sean.
Cheers, guys.